All right, not a good start to the week, but was a little bit too much too fast. I'm going to break down the technical patterns that came out of this big opening gap here to the week, and what it could mean for the rest of the week, and how we could trade, especially with some of the moves, some of the big moves that we've had in different asset classes, and how they relate to what just happened in stocks, where there might be some support levels, where the selling can end. And how far up if we bounce, how far up we may bounce, whether or not we've had enough of an intermediate pullback now. So I'm going to break all that down in today's video, as well as a trade idea to see if we can't take advantage of this dip. So let's go ahead and get started. Today is Monday, January the 27th, 2020. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see, you can't really see today's action. It's right there. You got a yellow line because we closed below the moving average. We don't quite have the pink shading yet. Remember, that's a very bullish pattern, except when you are 4 months in. So it might lead to a bounce in the short term. We might fill in some of that gap towards 3,300. I wouldn't expect this to bounce up for another multi-week run on this. It is a very oversold pattern here. The near-term line dipped its toe a little bit, and the momentum line didn't get to extreme lows because we didn't finish at the low of the day. So there is a little bit of a bullish pattern, short-term bullish bounce pattern. You can see on the Russell 2000, there's that pink shading that I'm talking to you about, in the yellow line, which we actually had before. And again, you can see not so bullish, and the near-term line's setting up for a pretty significant bullish divergence. So, as I mentioned, and I tweeted out last night, a lot of the volume, a lot of the selling that occurred today occurred overnight. Like, we didn't have, you can see on SPX especially, we didn't have a lot of selling throughout the day today. We didn't have very much buying either. So the selling that occurred overnight on very low volume, mind you, held. So the buyers weren't able to come in and fill that in. But also, you notice we didn't keep going down either. So that's why I mentioned, if we dead cat bounce and we can't hold this low point tomorrow or the next day, but if we break through the high point, then there's a good chance we fill in. If we can't hold that low point, then there's a good chance we continue to be bearish. And again, this isn't like, look, we're just barely getting to 23% retracement. We talked about that as a possibility, if and when we ever got a pullback of an area we get down to. And we also talked about the idea of, from a seasonality standpoint, going into February the 10th, was it? So right before February expiration, and we're typically bearish anyway, and that's where the time series is set up. So if I were to here add on some time, here we go. I don't know why it doesn't ever go to that. But if I were to add on some time here, and then put on that Fibonacci time series again that we talked about before, so going all the way out here to February the 10th, and we can just do that wherever we want to do it. Then again, this is that February the 12th now, and you can see where that Fibonacci fan is, the 50% fan kind of crossing the 30, a little bit after that date, right before the expiration date. So there's kind of again, that's a target that we can get down to. And just to kind of give you an idea, from where we're at right now to that level, it would take 3 more weeks, and it would only be a 3% drop from where we're at right now. So, and we're not talking, this isn't significant pullbacks that we're getting here. I mean, we're down 2.5%. I mean, that should put in the context. I mean, we had a market sell-off. We didn't have a market buy-off. When we went up 7%, 9%, and then 7% with only a 1.9%. Where were the market buy-off, things? It's, we came down pretty hard, but the market was set up. The environment was set up for that engulfing pattern there, and then, of course the catalyst of the coronavirus in China. But we were already in a mature intermediate trend, and that continues to be the case. We're still in a mature intermediate trend. We're going on 4 months. Into this rally. That's a long time. And the intermediate pullback, if this is it, the intermediate pullback's not done. We haven't even crossed below 80 yet on the S&P, much less below 50. So kind of keep that target in mind that I've talked to you about before, as well as the time frame. And most likely won't go down every single day. In fact, I honestly wouldn't be surprised if we don't bounce back up towards 3,300 in the next little bit and start filling in that gap filling in that gap there that we had this morning. And again, the Russell 2000 giving you that pattern, especially with that bullish divergence setting up here. But the Russell 2000 kind of giving you that pattern that says, okay, there's a good chance we can bounce up. And we had this intermediate divergence here. We're breaking through that low point actually in between those two highs. So, we might, there's, and as I said before, even as I said on Friday, there's a good chance that this is the beginning of the intermediate pullback, but it's not like, we can come down to the 50% retracement level here and still be fine. You can see on the S&P, there's a pretty decent volume node right here, and the next one's actually down below the 38% level, down towards this 311, 310 area. So, keep that in mind in terms of SPY, and of course in IWM, we're kind of breaking through a pretty decent volume node. Which is now going to kind of lines up as a resistance with the high today. So again, that kind of idea of this dead cat bounce, if we go below the ground, which is today's low, then that cat's going to get buried, and we'll continue this intermediate pullback down towards support, where there's tremendously large support down here. So we are definitely not falling off a cliff, but we might get down a little bit faster. Again, shouldn't be a big deal for most of you, unless you're more bullish this last couple of weeks than you were, a few months before that. We should have been progressively getting less and less bullish, so that if and when a pullback like this occurs, it doesn't hit us as hard. And so that's the nature of intermediate, especially mature intermediate run. Especially, if you get lucky and that intermediate run gets past the 3-month mark, that's the long end of the range, 1 to 3 months. That's a pretty good sign that we should not necessarily not be bullish anymore, because you can go 4, you can go 5 months. But it is a good sign that you're kind of running past the mark, so to speak. You're skiing over the tips of your skis or whatever. And eventually you just want to start de-risking at that point. We've had a good opportunity for that the last few weeks. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Click that red subscribe button that pops out. There's also one down below the video. That notifies you when these videos are posted. Also, click the thumbs up icon down below the video. That tells us 2 things. Number 1, you liked it. And number 2, you want us to do it again tomorrow. This is a quick way to give us feedback. Comment down below on anything that stood out to you from today's video. Join our website at marketscholars.com. There's a link popping out right up there in the top right corner of your screen. Click on that link. Subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website, I also invite you to check out our live video, Market Outlook live video that we do at 3:30 Eastern Time. We actually review all our old Market Outlook trade ideas, as well as put on today's trade idea before the market closes. So check that out, as well as all of our classes. They're all available for our monthly subscription, our Plus plan. You get more details by clicking here or going up here to our Plus plan. You get access to all of our classes, as well as our Market Outlook live videos. Also engage with us on social media. Click this little heart right here. It opens up a new window where you can like today's Market Outlook tweet. Also hit this thumbs up. Takes you to our Facebook page. You can like today's Market Outlook Facebook post. Again, the benefit for us is it pushes out our content to all the people who follows us. The more stuff that's been engaged with. And then it's benefit for you because they will promote the content that you engage with the most in your timelines. So we hope to be there as well. All right, now let's go back and take a look at the long-term chart here. So you can see there's our bearish reversal candle, and so again you see that this. It could only last a couple of weeks. We didn't get a transition here, straight up transition. We went straight to being bearish, but this kind of shows that this week, this kind of selling. If we do bounce back up, we're probably not going to bounce back up to a new 13-week bullish trend anymore. We're more than likely going to get a week or 2 of bearishness before we finally get another candle. Remember, the reversal candles after bearish moves tend to be bigger ranges than the reversal candles on the bullish moves. Here was one where we kind of went from bullish to bearish, and you see how that lasted a few weeks. We got a lot higher PPO now than we have there, so that's why I expect something more kind of like in this area where we kind of flirt with the 50-day moving average, but don't really break down inside of it too far to the 200-day moving average. There is some support in this area, but we'd have to really be breaking some significant support. I mean, just to kind of give you an idea, here is from this low all the way up to that high point. To get all the way down to the 200-day moving average, we'd have to be breaking through the Fibonacci retracement zone all the way to the very bottom of it. So I don't expect that to happen, but I do expect we'll probably get towards a 23. If I were to activate this drawing, excuse me, if I were to edit that and bring on the 23% level, and again, this is on SPX, you can see that, you know, this flirting around here with the 50-day will keep us around that 23% retracement. Remember, there's a pretty decent volume node right here in this area. Let's take a look at the 3 green arrow charts, and you can see again 3 red arrows today, and that's typically a buy signal on a bullish trend. So we'll see how much usually on more of a, you know, it's not so, the trend's not so big, so we'll see if it turns into one this go around, because again, if we bounce here, I'm not expecting a multi-week run out of this. I would expect maybe towards the end of the week, and that's it, just to consolidate this drop, but not anywhere close to new highs. Of course, anything happen, but again, you can see where that, you know, there's some support in this area here, so it's not going to be easy for us to just fall off the cliff per se. Take a look at the 2 line versions, and you can see the MACD is still really high. I mean, it's pulled down, but look at the moving average. So I expect we'll probably come back up to it. You know, here we came down pretty quickly, but not when you're this bullish for this long. I would expect they'll probably come back up here towards that orange line before rolling back over again and converging. You can see where, you know, when you go from dropping below the 8-day after not having dropped below the 8-day hardly at all to boom in one day dropping below the 30-day, a lot of times that's a little too extreme in a small amount of time, and we usually come back up, probably even get back above the 8-day at that point, bring the blue line back up towards the orange, and then continue to grind and converge our way for that orange line to converge its way towards 0 before we do get more of that sustained intermediate pullback. All right, let's take a look at the intraday moves, and you can see there's that point of control. So not only on the daily chart, but also on the intraday chart, there's a pretty significant support here in this area, and you can see where the gap is. It actually did fill in a little bit this morning, and you can see how little volume there is in there. So if we were to break up above today's high point tomorrow, there's a good chance that we continue to move through all the way up to around this 328 area, which now is going to act as a resistance, and especially this one, and especially as this comes off, your point of control is going to shift way up here to the top, because that's your biggest node here. So that's going to come off the table a little bit as these days come off. But you can kind of see why we stopped here where we did. Let's take a look at the volume and the trading range. So 84 million, which is not too extreme. And keep in mind the trading range, it was by itself without the gap above average. When you include the gap, we closed at 328.77. The high was at 325.17. So when you look at, you know, what would that be? 325.77 would be 3 points. And then you add on another half a point to the downside. So that's 3.5 you add on to there. So you're looking at about 6-point range when you include the gap overnight. And remember, most of the ranging was overnight in the really low volume environment. And then 84 million, you can see 84 million is up here, so it's bringing the line up. 6-point range was obviously above 1%. You can see the ATR is rising. We're not above, you know, we're not above that 1% mark yet. So, I mean, we're not in the free fall here, and we're not getting extreme moves. Today's a little bit of it was extreme enough that I think similar to this day right here. Now, I don't know if it'll work exactly like this, but similar to this day, this was the Trump tweet that they might wait on the trade deal a few days later. So obviously, this isn't just a tweet related, and there's obviously something going on right now that won't resolve itself in the next couple of days. The question is, will it get worse in the next couple of days? Because the market has pricing in a pretty dire scenario based on what they currently have in terms of information, obviously with the selling that we've had in these 2 days. So it would have to continue to worsen in terms of, and make the expectations worse. If they don't, if the expectations remain as dire as they are now, for the markets to price this in, then you can get just a kind of a relief exhaustion type rally, which I wouldn't expect to last too long, just enough to fill in that gap and get back into this area, hit this resistance, then continue the intermediate pullback. Just not so sudden and fast as like what we've seen in the last couple of days. Let's take a look at the volatility index, and volatility spiked up, came down, finished up at the high, but you can see we got up, closing in the 1% mark. So we're still, you kind of got to get above that 1% mark to really get this intermediate pullback going. Here's the other times we got above 95%. You can see how we came down throughout the day. So we'll see, if this ends up holding or not. Very similar to this pattern over here where we start high and come down throughout the day. If you're going to get an intermediate pullback, you got to get above 1%, like we saw these last two times. We're flirting with 1%, getting just slightly above it. We'll see if we stay above this or we break back down below. If we break back down below 1%, then the intermediate pullback is going to be more of a grind. If we spike back up, and remember, 115 is the mark where you start getting the market sentiment pullbacks. Because everything starts with a big spike in volatility, right? All the big moves start with a big spike in volatility, and then we continue to grind. We go lower as volatility starts to pull back. So it's how high do we get? Well, as we get above this 1% mark, that's the intermediate pullbacks, and you get above 115, that typically starts to market sentiment pullbacks, which obviously are a lot more sustained in terms of the grind. So we're getting there, and you can see the volatility. We've been, as high as it is, it's been higher before. Remember, I told you the spikes come out of nowhere, but then they don't last very long. So we've had a couple of days now where we haven't had filled-in candles. So don't be surprised if we don't have a filled-in candle tomorrow, because that's the typical nature of the beast after you get a day or two of open candles like this. All right, so before we look at what's driving this price action, to summarize our technical outlook, obviously we had a pretty big drop today, and it was, in a short amount of time, it was a pretty outsized drop. So don't be surprised that here in the next day or two if we don't kind of bounce back up in the short term. And I do expect this to be the beginning of the intermediate pullback, and I expect that process to play out over a few weeks. So we're definitely not over. And there's a time frame, there's a target to the downside, as I mentioned in the video. It's not going to go down every single day. Just like markets don't go up every single day. Seems like they do, but they don't. And that's not how markets don't go up every day until they go down. They don't go down it's just not how it goes up and down, especially when you get the big extremes. So we had a little bit of an extreme today, and we'll see if it doesn't bounce back up and see what happens there. But don't expect a new intermediate run to start. I mean, this wasn't the intermediate pullback just today. There's still more to come. It might not be every day like this in terms of the depth of the selling, but we might have more down days and up days here in the near future, and that's okay, because that will set us up for a new low point that we can start a new intermediate run off of. Because just as seasonality is pretty weak here until that February expiration. After that, it's pretty strong until May 1st, right, and even beyond that, but until May 1st is a pretty strong seasonal trend. So, it'd be nice to get a new intermediate low point that we can bounce off of here at the beginning of February and get going on that new multi-month intermediate run and be able to put some risk on the table as we approach a low point, instead of worrying about a mature intermediate run where we have to de-risk instead, which is what we've been in probably for the last 3-4 weeks here. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below on why. What are you seeing that suggests why you're either a lot more bullish or a lot more bearish than I am today? All right, now let's take a look at how things performed here just today. And see how the markets reacted to this move here. So let me bring over, there we go, to a 10-minute chart here. So not surprising to see long-term bonds up 1.5%, gold's up, emerging markets down, a big culprit as to why. You see over here China, the biggest loser on the day. Crude oil also down quite a bit, continuing its path to the downside. Remember, crude oil is really struggling here. Had a bad week last week. We're already struggling here this week. Getting a death cross right now, even though it didn't really have much of a excuse me, didn't have much of a golden cross to begin with. There's bonds continuing their reversal to the upside. And then finally gold. Let's take a look at gold. You can see also continuing its upward. Now gold's a little different because it's got that long upper shadow that's going to have a hard time, and plus it's got this big time divergence going on here with the lower highs on the PPO with already much higher highs on the index itself. But you can also see too that we are pretty bearish right now in crude oil, but keep in mind that we're not like breaking through this important like 62% level. Much less the 47.5 level, where we really start making a move to the downside when you're doing this Fibonacci retracement series. So these are big moves going in the wrong direction, but they're not big moves. And you can see the 10-year yield dropping to 1.6 or 1.6%. These are big extreme moves to the downside, but they're extreme. That we're already making pretty decent moves in the positive direction for the safety trade, and the question is whether or not they're going to resume their trends. Remember, they had such strong trends going into really that October low point. They all kind of peaked there in September, and the reality is, are we going to start a new leg? And most likely the scenario is not, and it's setting up for again a new low point to form for the safety, or a new high point to form for the safety trade when you look at it that perspective, and a new low point to form for equities. And you can see not quite the same pattern as you would expect in equities. Remember, equities, the safety trade is really making a move in the wrong direction. You would think that the equities would be down here right now compared to what some of these other trades are doing, but instead we're way up at all-time highs, still close to it, and not even coming close to even the 50-day moving average. When you look at the Russell 2000, we're dipping our toe just a little bit under the 50, which is kind of what I expect to happen on the S&P, and that's it. So equities really aren't selling off nearly as hardly, except for emerging markets, of course. And they basically have filled in the gap to the 200-day moving average. So the question now is, we're going to get something like this and bounce and renew the trend, which again is what we'd expect to have happen, or are we going to really move to the downside here, similar to what we saw last May? And depending upon how long this issue in China persists, we would expect the former. We'd expect more of a move where we just test the 200-day moving average and bounce back up again and get going, like I expect 2020 to be, very similar to 17, if not necessarily in the magnitude, at least in the same direction. If we take a look at all the major economies out there, look at China dropping. Obviously China dropped the most. Japan had a big drop. So did Korea, Italy. They all dropped significantly below. They're all pink except for Canada dropping to its moving average, and the U.S. dropping to its moving average. Everything else dropping well below and showing red lines. Red line on China, red line on Japan. Everything's a red line except for Korea and Russia right now. Which are just happen to be in India, which happen to be some outperformers. So everything's dropped. Now the question is whether or not we start to fill in these gaps that we produced over the weekend, over this weekend, see what happens here. When you look at the calendar, you can see we got a pretty busy calendar coming up here with durable goods orders and the Case-Shiller home price index, consumer confidence. So pretty busy with the FOMC meeting beginning. Of course, that's kind of the biggest news of the week. But keep in mind that most likely scenarios, the Fed's not going to do anything. You can see there's a small chance they actually raise rates, and no one's really expecting them to raise rates. You can see even by the end of the year, no one's expecting them to raise rates anymore. The odds of one rate hike are 2.7%. The odds of a rate cut actually are still pretty relatively high here. And in fact, you can see we only got about a 25% chance that we stay with a rate where we're at or higher. That's down from a week ago, which was at 40%, and a month ago was at 48%. So about a 50-50 shot that we would get a rate cut, and now it's a 75% chance, essentially, that we'll get a rate cut sometime this year. So you can kind of see the bias here with yields falling as much as they are. They've really propped up the odds of a rate cut in 2016. You can see the the estimates for GDP are down a little bit below 2%, down to 1.8%, and it'll be updated again finally here tomorrow. So from a macro perspective, things are still relatively positive. We're not really tanking anymore in terms of economic indicators. Inflation expectations falling, simply really because of what's been going on the last couple of weeks from a geopolitical standpoint, from a commodity standpoint as well as yields. The question is whether or not it's a shock, so to speak, a temporary factor, which is what I believe it is, or is it a start of a new trend, a lengthy trend in inflation expectations and the safety trade, where eventually equities being as overbought as they are, maybe enter more of a market sentiment pullback and not just an intermediate pullback. And I don't believe that's necessarily the case, but it's something to keep an eye on because of how sharply the safety trade has moved in the last few weeks. When you look at the sector rotations here, you can see there's still a lot of pretty dark green, including the safety trade. The safety trade is still really dark green, but communication services and technology is bullish as they, as bearish as the market has been, and some of these looking really bearish. Energy, look how energy is down, materials is down, financials has really come below its moving average. Everything else is showing light pink shading and yellow lines, especially for industrials and discretionary. Well, more so industrials hasn't been that bullish for a while. Really, discretionary hasn't been that bullish for a while either in terms of when the intermediate run started here. Some of these others have been more bullish, healthcare and financials, and technology and communication services have been bullish for a lot longer period of time. So it'd be interesting to see if these kind of bullish bounce patterns play out here tomorrow. If we take a look at just what happened here today alone. So, oops, sorry. Let's do this chart right here, the one grid. And let's go to the time frame. So we'll go out to today. Go to 10-minute chart. You can see the safety trade outperforming down, but outperforming in your cyclical areas, especially your dollar-sensitive areas, materials and energy. But you can also see technology giving up some gains, industrials, and you can see some of these other cyclical areas following, discretionary communication services and financials all kind of following the market down. So very risk-off type of a move, but keep in mind they had some gains to give back, right? So they've had a really decent run really since that October 8th low point. When you go from that October 8th low point of 2019 here, they've got some gains to get back in some of these areas, whereas we've been struggling in some of these safety trades. You can see how much. So again, that's why I'm not buying these big moves in the safety areas, because it's basically just an oversold rally and an overbought pullback in some of these cyclical areas right now until I see something different. So speaking of that technology sector, I did want to take a look at a stock here, one of the bellwethers, Qualcomm. You can see it's gotten that pullback pattern where you have the light pink shading and the yellow line. You can also see too, if I pull up its three green arrow chart, it's got 3 red arrows today, so pulling down below the moving average. You can see from an Ichimoku cloud standpoint, we're still easily above the cloud, kind of dropped to the cloud and acting as support below the blue line, giving an opportunity for a bounce pattern. We had a little bit of a bullish trend that's now turned noisy there. If you look at the Bollinger Bands, we are down to a significant layer or so. I mean, this is a pretty significant layer of support here. Break through this area below 85, and now we're really pushing to the downside. We are into the lower half of the chart. So we'll either bounce off of this and continue higher, or we won't. So that sets us up for, and well, let me give you that long-term view first, and then we'll take a look at the trade. So there's that long-term view just kind of dipping its toe below the 50-day moving average. So it's got a really strong momentum right now going forward here. So to try to take advantage of the dip and the strong momentum with that earnings coming up, we'll take a look at selling an option that's a little bit out there, and then buying it out of the money option that's below 40 in the delta, and selling an option to help fund that, to kind of give you an idea what that looks like. There's the short strike price, well within 1 standard deviation move to the upside. Here, let's reset these. And then you have, and here we'll do, this is set size to break even. So there's our break-even price, but you can see our break-even price as of right now is where that red notch is. We're just a little bit down because we put this trade on before the market closed here. There we go. Before the market closed, so you can see where it has to go to get up to, and it's got earnings. So we position size for worst case scenario for half of what our normal risk is. But again, we'd like to get out of it. If it does pull back, continue to break, it breaks through 85, then we'll try to get out of it with half of that. But you see what the maximum gain is. So if we're putting about $280 at risk roughly to get $1,500 of reward, that's a pretty decent reward to risk ratio to see if we buy if this bounces off of this dip pattern or not. All right, well that does it for today. You've heard from me now. Now I want to hear from you. So use that link right there in the top right corner of your screen. It takes you to our forums. Open up any new thread. Let's keep this conversation going on what's going on in the markets and what we can do about it and what we expect to see. Any questions I didn't cover in today's video, any topics I didn't cover, obviously pertaining to the subject, open up a new thread there and be sure to reply to anybody else's threads too. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content in between videos, and join our community at marketscholars.com as well as our Facebook group. Have a great rest of your evening, everybody, and we'll see you all tomorrow.